Good afternoon, everyone. Thank you very much for joining the JKH Investor Relations webinar for Q2 24-25, and welcome. I am Gihan Kure, Deputy Chairperson and Group Finance Director. I am joined by our Chairperson and CEO, Krishan Balendra, for today's webinar. The format of the webinar, as usual, will be where Krishan will initially take us through an update on the macro environment and some of the key developments during the quarter. And then I will take you through a presentation of some of the key financial highlights during the quarter. And then we will open out for a question and answer session. If you have any questions, please enter it in the Q&A tab at the bottom of your screens. And with that, I'd like to invite Krishan to take over and give us an update on the macro. Thank you.
Thanks, Gihan. Good afternoon, everyone. During the quarter, towards the end of September, we had a presidential election in Sri Lanka, and a new president was elected. Almost soon after the election, the president and the government announced that they would remain committed to the IMF program and continue to operate within the parameters of the IMF program, and also that they would honor the agreement that the previous regime had reached with the holders of the international sovereign bonds, which was agreed just prior to the previous presidential election. The key officials who were running the economy, the governor of the central bank and the treasury secretary, also continue to be in office. With the announcement that the agreement with the ISB holders would be honored, it is now expected that the bond exchange will happen before the end of the calendar year, and it is also expected that Sri Lanka would get a country rating upgrade also with the bond exchange. The other economic indicators continue to be positive. Inflation continues to be very low. In fact, we've seen marginal deflation in the last couple of months. The rupee has strengthened in the last 2 months at about 293, 294 to the US dollar. The primary surplus and the tax revenues that have been announced to date for the calendar year have exceeded the targets that have been set, which were agreed together with the IMF. In fact, comfortably exceeded the targets. So generally, the momentum that we are seeing with the economy is positive. Just after the end of the quarter, mid-October, we opened the Cinnamon Life Hotel at City of Dreams, Sri Lanka. That is a 687-room hotel. Some of the restaurants and bars we will open over the next few weeks, and all components of the hotel will be fully operational by early December. The casino space to be operated by Melco, the Nuva Hotel, which will also be operated by Melco, will open on the 1st of August, and the shopping mall is also expected to open then. Tourism, just on the businesses, the outlook for this winter season is looking very promising. If we look at the bookings we have on our books at the moment, they are greater than what we had this time last year, and the indications are that the winter season should be as strong as the last winter prior to COVID, and actually prior to the incidents in April 2019. The beach in particular, given the mix of arrivals that we are anticipating and the bookings that we are seeing, the beach is looking very strong. on the southern coast where John Keel's has, or Cinnamon Hotels, has 4 properties. Consumption has also continued to pick up, as you would have seen with our numbers. Our soft drinks, ice cream, processed meats business have all seen better volumes in the quarter, and we expect that momentum to continue. We will go into more detail during the presentation and during the Q&A. The West Container Terminal, as we said the last time as well, is very much on track. The cranes for the main quay area and the yard arrived during the second quarter. Construction is progressing very well, and we expect that we will be able to receive the first ship in the March quarter of next year. So that was a quick high-level update. I'll hand over to Gihan to run through the presentation and some of the details, and we are both here for Q&A after that.
Thank you, Krishan. So we move on to the presentation for Q2. So in terms of the EBITDA for the quarter ended 30th September, all our key businesses, with the exception of leisure, saw EBITDA growth. Leisure, of course, there are specific reasons, particularly, as Krishan said, with the ramping up of the Cinnamon Life at City of Dreams. We are now, of course, we opened the hotel, but there was all the ramp-up costs, and essentially we've got all the staff that are needed to operate the hotel. So we have significant cost being expensed at this moment. So we've normalized that. So if you look at the numbers on the screen, you'll see, and I'll go through the details, you'll see that transportation, consumer and retail all saw very strong growth during the quarter. In leisure, because of the City of Dreams number, so we had about close to 1.2 billion of costs pertaining to the City of Dreams, Sri Lanka, compared to only about 200 million last year. So almost ₹1 billion of additional costs hitting the P&L, and that's the primary reason for the reduction that you see in the leisure business. But yes, ex of City of Dreams, we also still did see the rest of leisure coming off marginally, primarily due to the appreciation of the rupee, but there are a few other factors which I'll take you through. But overall, if you look at it on a headline basis, the EBITDA was at 8,095 million, which is a marginal drop of 4%. But if you exclude the impact of the pre-opening costs of City of Dreams, we saw 8% growth in EBITDA for the quarter. In terms of the performance for the 6 months, I won't go through the details here, but naturally the momentum that we saw, particularly in the consumer and retail businesses, that momentum has continued from Q1 to Q2. So you're seeing that strong contribution coming through. The transportation business in Q1 didn't show growth, but which is why you see the cumulative performance still being negative. But as I just spoke, the Q2 performance has shown progress and growth. This is just a quick snapshot in terms of the quarterly movement of EBITDA, so going from left to right of the screen. So if you look at it, ex of the City of Dreams number, we did an EBITDA of about 9.3 billion compared with 8.6 billion, which is the growth I earlier spoke of. Of course, there is seasonality. So if you look at it across the different quarters, Q3, Q4 tends to be anyway the stronger 2 quarters for the group, driven by seasonality, of course, in the leisure business as we head into the peak season in Q3, but more so in Q4. And then some of our other businesses like even retail and consumer do see some impact of seasonality. So in that context, looking forward into Q3 and Q4, if the current momentum continues, then the EBITDA growth should be there. The other thing I'd like to just point out is the line on the exchange rate. So if you look at it last year in Q2, we had an average exchange rate for the quarter of 322 rupees, and that is now at 302 rupees during the quarter. And of course, at the quarter end, our balance sheet rate, we had a rupee closing rate of 297. So this has, in terms of translation, impact on our performance of our businesses, particularly in transportation and leisure. We've seen some negative impact, but of course on the other side we see some benefits in terms of input costs in our businesses, but naturally the immediate impact on the two more export-oriented businesses like transportation and leisure is felt more immediately. Just in terms of our finance cost for the group, I won't take a lot of time on this, but if you look at it in terms of X of some of the exchange impacts, the finance costs are at around the same level. So that volatility that we saw in the previous years is now not there anymore. Of course, with the rupee movements and the dollar loans that we have in our books, we do have exchange gains or losses coming in. So we've normalized that when we try to show this, but if you look at leisure, the finance cost is actually a negative because of the appreciation of the rupee, which has affected the loan that we have at Waterfront Properties, which is essentially the City of Dreams project. And because it's a dollar loan, the appreciation has given us an exchange gain. So we've taken that out in terms of what we had from Q1 to Q2 and looked at a more normalized level. In terms of interest rates, the rupee prime lending rate on average is marginally lower than what we saw even in Q1, though rates now have sort of stabilized, so rates would be at around these levels or maybe slightly higher, but this is the average rate for the quarter. Looking at the PBT of the group, a lot of the same flow-through effects of EBITDA naturally come through, but also in terms of some of the interest costs and normalizing of the working capital costs, we've seen that benefit come through, particularly in our consumer retail businesses as well. So if you look at it again, there are the exchange impacts, which I won't go through the details of. I touched on it in the previous slide. But if you exclude those and look at a more normalized performance, then you see from Q2 to Q2 last year to this year, we've seen about a 30% growth in the PBT. Looking at some of our key balance sheet indicators, so our total level of group debt has increased slightly as expected as we continue to infuse funds into the Cinnamon Life project as we now sort of are operational, but there's still more funds that will go in over the next quarter or two. So that's the planned infusions that we have into the Cinnamon Life project. So that is the main reason for the increase in the total group debt and even the net debt. But the overall net debt, if you look at it excluding leases and the debenture to equity, is at around 37%, which is at a comfortable level. These numbers naturally are as at 30th September. And as you know, and I'll talk you through the next slide, we had the rights issue, which was concluded, but those funds came in post the quarter. So the numbers that you just saw do not exclude the 24 billion rupees that we raised through the rights issue. So as you all know, the rights issue was successfully concluded. We raised the 24 billion rupees that we were looking to raise. The issue itself was oversubscribed with additional shares being applied for, but we raised the quantum we were looking to raise. And post that, then we had the subdivision of the shares. And in fact, post the suspension of trading for the administrative aspects of the subdivision, the share recommenced trading today. Just a few highlights on some of our key ESG initiatives. We saw our carbon footprint decrease on a per million rupees of revenue, as well as our water withdrawal. A lot of different initiatives in terms of our One JKH and the E&I focused areas as well during the quarter. Moving on to the businesses itself, you can see here how the volumes in all three terminals at the Port of Colombo have been over the last couple of quarters. SAGT in particular saw volume growth over last year, marginally flat over last quarter, but we are operating at pretty much full capacity. If you look at it against last year, there was around a 6% growth in volume, but the main reason for that growth is also transshipment grew, but domestic volumes also grew. So if you look at the mix, you can see there's a favorable change in the mix from around 10% of domestic volume, that number has moved to 13%. So apart from the actual increase in the number of TEUs, doing more domestic boxes is more positive from a revenue perspective and yield perspective, which did translate to an improvement in the profitability at SAGT. Our bunkering business also saw very strong growth in volumes. So we saw growth in volumes of around 78% of last year. Yes, last year we did see a decline in volumes, but even if you adjust for that base effect, we saw significant growth in volume, aided by also the issues with the Red Sea crisis, which has helped both the ports and bunkering businesses. Overall, both businesses saw growth in profitability. And as I touched on previously, this is despite the appreciation of the rupee, which did appreciate by around 6 to 7%. So had it not been for that, these businesses in rupee terms would have done even better. Krishan already spoke of the progress on the West Container Terminal, so I won't go through the details, but essentially just to reiterate the point that we will be operational from first quarter of calendar year 2025. And you can see the progress that's been made. This is maybe a month or so old, but the cranes are now being installed and testing, commissioning is happening as we speak. Well earlier. So the momentum that we saw in Q1 has continued through in Q2. Strong growth in volumes in ice creams, soft drinks as well in terms of the CSD segment, as well as our consumer foods business also has seen consecutive quarters now of volume growth. So overall, very good growth in EBITDA over last year, very strong growth in EBITDA. Even our EBITDA margins over last year have increased from 15% going up to 17%. And on a quarter-to-quarter basis as well, we did see an improvement in margins. The bulk to impulse mix also, I think last quarter we mentioned that there was an increase in the bulk. So the overall volumes in ice creams grew. We saw bulk ice creams grow because of certain demand factors, but that's normalized, and we've seen the ratio of bulk to impulse normalize, which has also helped margins. And overall, the current momentum we are seeing in terms of volume growth and consumer demand is expected to continue and remain positive. If you look at it in terms of the margins itself, from the sort of lows that we saw late the previous year, we've seen a continuous upward trend, and we expect margins to sort of stabilize at around these levels. If you look at it in terms of the indexed volumes that we've seen volumes broadly in line with Q1 last year, and that of course, like I said earlier, there is some level of seasonality as well. But overall, we've seen that volume growth momentum continue. If you look at it even in terms of ice creams, it is the same sort of trend where we've seen strong growth in ice cream volumes. Moving on to our supermarkets business, strong same-store sales were achieved in the quarter, so around 14% of same-store sales. And I'll get into the decomposition of this, but on a sort of more higher level, it was driven mainly by footfall. As we've seen over the last couple of quarters, we've seen double-digit footfall growth over the last 5 quarters. So that same momentum is continuing with footfall growth at 12.3%. And ABVs, I think we've spoken of this over the last couple of quarters, where ABV was initially in the negative territory, but in the last quarter was all basically flat. And now we've seen that growing at 1.4%. And like I said, I'll get into the decomposition of that. So overall, we've seen a strong EBITDA growth again in this business, driven by the supermarkets business, but our other business, the office automation business, also did see growth. EBITDA margins in supermarkets have increased to 7.1% from 6.4%. And even on a quarter-to-quarter basis, we've seen an increase aided by the top line growth as well, but some cost reductions, which I'll talk to you about. Overall, the new energy vehicles, we are seeing very good traction, strong demand continuing for the vehicles. The The market is yet to open out, but we've opened out the bookings and continue to see strong demand coming through. In terms of the margins, I already spoke of the margins and the absolute profitability. So we've seen that increase. Q4, as we've mentioned before, is a strong seasonal quarter, as well as in that year end, we have a certain level of year-end profit recognition on promotional incomes and so on, which is why you see that peak, which is more a seasonal impact that is there. If you look at the margins, like I said, over the last couple of quarters, again, you see the Q4 impact because of that one-off impact, but otherwise you see the margins at 7% is quite healthy. Margins have been aided to some extent by the reduction in the electricity cost as a percentage of revenue, but overall margin growth also has been positive. Looking at the decomposition of same-store sales itself, if you look at footfall growth, we saw 12% growth, like I mentioned. This is driven by a combination of footfall of new customers coming into store as well, but also existing customers increasing their frequency of visits to the store. So the combination of that is what has helped drive this 12% growth in footfall. Similarly, if you look at ABV, it's a factor of the retail selling price or inflation, as well as the number of units purchased in a basket, or the weight of purchase as we refer to it. So if you look at the inflation side of it, we've seen inflation being marginally down in the quarter, and what has really helped is that the weight of purchase or number of units in the basket has started to pick up and increase vis-a-vis last year, which is aiding that marginal growth. It's still marginal, but that growth in ABV. So as consumer confidence it has returned, and if that same momentum continues, then hopefully we should see even the weight of purchase continuing to increase. Moving on to leisure and tourism, we've seen the same momentum continue over the last couple of months, where tourism has increased. Of course, it is now starting to head into the peak season, but Q2 is really more of the off season in Sri Lanka. But if you look at it compared to 2018, we're still seeing the run rate being at about 85% of the pre-pandemic and pre-Easter impacts. So tourism itself hasn't fully recovered, but as Krishan touched on previously, we are seeing good forward bookings, visibility and momentum, and particularly that matters heading into December, Jan, Feb, March, which are really the peak periods for tourism in Sri Lanka. Moving on to Maldives, we've seen the numbers again grow over last year. The Maldives did witness some disruptions, and maybe we can talk through that in the Q&A session, but overall the numbers to Maldives has still remained quite robust and resilient. I will just skip this slide where we talk of the potential for Indian tourism to grow, and we've spoken of that before. In terms of the numbers in leisure, if you look at the Colombo hotels, occupancy was flat against last year. We saw ARR growth against Q2 last year. The EBITDA margins were slightly down. We did have some costs pertaining to right sizing of the hotel at Cinnamon Grand, where we essentially took a call to look at moving some of our restaurants, right sizing the staff, as well as shutting down one or two of our restaurants. So that right sizing had some costs that came in Q2, but had it not been for that, because of that type of ARR growth that we saw in Colombo hotels from $69 to $83, the EBITDA margin would have improved, and that reason for the decline is due to what I just mentioned. If you look at Sri Lanka resorts, again keeping in mind that it's the off season, but we saw marginal decline in occupancy versus last year Q2, a growth in ARRs, which did help drive a slight growth in the EBITDA margins. In the Maldives, we saw a growth in occupancy where there was a conscious strategy of driving the occupancy a little higher, and then bringing our yields down to have more of that volume driven strategy. So that did work, and our margins are largely in line with last year. Part of the reasons for the decline in performance, like I said right at the outset, is due to the appreciation of the rupee, and that translation impact also did not help. And apart from that, like I mentioned before, we had about a 1 billion rupee impact of the cost of City of Dreams coming in. Now, just to reiterate the point that this is pertaining to, yes, the ramp up, but as we've commenced operations, it's really the 1,400, 500 staff that we have there, as well as the entirety of the cost structure that's there with the City of Dreams. Of course, as we start generating revenue, which we have, and the room revenue and F&B revenue starts picking up, the costs will get absorbed, but there's that initial period where we will have those impacts. And of course, once we open City of Dreams, or we have opened it, and once we start seeing the impacts, we will see the impact of the finance cost and the depreciation, which were previously capitalized, coming into the P&L as well. But overall, we are very positive about the impact of City of Dreams. It's very encouraging in terms of the type of feedback we've got. It's of course early days. We've been open for just around 3 weeks now, but it's very positive feedback. We've opened part of the restaurants, and a couple are due to open in the next week or two. So it was planned to sort of have that staggered opening to maintain that momentum. And so we'll talk a little bit more about City of Dreams as we go through the rest of the presentation. I won't go through these slides. You all already know about the different components of the hotels. So like Krishan said, we've opened the 687 room Cinnamon Life Hotel. The 113 key Noir Hotel will be opened by mid next year. We've made very good progress, or Melco's made very good progress on the fitting out and the construction part of the gaming flow. So very good progress made so far, and things are on track for the mid 2025 opening. Just some images, actual images of some of the restaurants, as well as the reception areas and the rooms, for those of you who may not have seen this. In terms of an update on our property business, we've seen good momentum with the inquiries for Cinnamon Life. The apartments there, as we've said over the last quarter or two, lots more leads, lot more inquiries. And we, in fact, in the last quarter saw the conversion of some of those into sales. So where we saw 5 sales happening at the Cinnamon Life. So the number has now moved to 262 units from what we had in the previous quarter. So that momentum will continue with current interest rates low. Despite, the uncertainties, or, just with the elections coming up, I think the people were just taking a slight wait and see approach. We will conclude the general election on the 14th of November, and then Parliament will reconvene on the 21st. So thereafter, we expect this momentum to pick up further as we get into completion of all the other aspects of the integrated development as well. With Trizen as well, we've seen good momentum. Now we are handing over units as well. So the project is essentially completed, and people are now residing in the property as well. So we expect this momentum of the final sales of around 170 units to take place over the next quarter or two. And with Viman, which is our suburban residential project, again, very good interest on the phase 1 and 2. We launched phase 2 as well. So we've seen sales of around 36 units of phase 2, and we have about 40 units remaining, and in phase 1, only 13 units remaining. So as we head into Q3, Q4, we will see more of that revenue recognition, particularly from Trizen, as we continue to hand over units, as well as if there are any sales on Cinnamon Life, and with Viman as well, as we get into the next couple of quarters. And given that we have started construction, we started construction in August, we will start seeing the revenue recognition commencing on Viman. Lastly, on financial services, we saw very good growth in GWP in our insurance business. So that momentum that we've seen over the last 5 quarters, where we've seen strong double-digit growth in GWPs, has continued, and the new business underwriting also has been very strong, which has translated to sort of solid profit in the business. In our banking business, this of course is because of the fact that they are also listed and their cycle doesn't fully align with us. They are yet to release their Q2 numbers, so I'm talking you through the Q1 numbers, but overall very strong profit growth that we've seen. In the bank, loan growth has been very strong. We've seen that in Q4 as well as Q1, loan growth of around 18%. NIMs have actually contracted against last year naturally with interest rates coming off, but has been quite stable and in fact marginally increased over the last couple of quarters. And the impairments on stage 3 loans have been quite flat against, and if you look at it against last year, has in fact improved. So overall, the bank has shown a very solid performance and we expect that momentum to continue. So with that, we conclude the presentation. I'd like to open it out for the Q&A session now. Just to remind you once again, if you have any questions, please enter it in the Q&A tab at the bottom of your screens. So just to start things off, Krishan, maybe we already spoke about the forward booking momentum in Sri Lanka, but in the Maldives, maybe if we could just elaborate a little bit about the current macro situation in the Maldives, as well as how Indian arrivals have been and what sort of impact we've seen in the composition of arrivals, though the headline numbers in terms of arrivals has been quite strong.
Yeah. So the Maldives on the macro, from what we are seeing and what has been stated, they are seeing some stress on foreign exchange and their balance of payments. Some of the regional countries have assisted the Maldives, and they appear to be now working towards stabilizing the economy. On arrivals, tourist arrivals, as you saw, in some months, if you take the calendar year to date, generally we have seen growth year on year in the overall arrivals number. In some months it has been flat, but that number is slightly distorted because a lot of the growth in numbers has gone to the hotels in the inhabited islands, which are at much lower room rates. And we saw an impact from the lower numbers from India with some of the political tensions that occurred earlier in the year. So in the first and second quarters of the current financial year, we have seen an impact from the lower Indian arrivals, particularly in that 3 to 4 star segment that we largely operate in, so which has impacted room rates. However, having said that, the outlook for the winter, last winter as well, we had quite a strong season with occupancies and room rates, and the outlook for the upcoming winter is also strong. And we expect that RevPARs will be better than the last winter. So generally, while the first 2 quarters have been negative, we are expecting that the second half will be much better.
Thanks, Krishan. Yeah. Just staying with leisure, but moving on to Cinnamon Life, I think there are a couple of similar questions, so maybe I'll just combine them. What are we seeing in terms of forward bookings at Cinnamon Life, and whether there are any large conferences that could act as catalysts for activating Colombo as a South Asian MICE center?
It's too early to comment. I mean, we've opened the hotel only 3 weeks back. We are seeing good momentum in terms of bookings for events, weddings, banquets. We've seen bookings for rooms. In the city, room bookings are usually more last minute compared to the resorts where bookings can happen 6 or even 9 months earlier. City bookings are usually just a few days, a few weeks. The leads and the inquiries in Sri Lanka and from overseas is encouraging. We don't have a firm booking for a large overseas event. We have a number of bookings for local large events, but there are a few leads which are promising. And we expect that it will translate to confirmed bookings in the next few weeks and months. So it's early days to comment in more certain terms at the moment.
Whilst we spoke of the outlook in the Maldives, Krishan, the specific question is about the tourism-related taxes that are also coming in, and what type of impact we could see, because that's of course a tax on that the guest pays the tax, but any further color we could add to that, as well as another question on Candy missed when we are hoping to commence operations.
Yeah, on the taxes in the Maldives, there is an increase in the tax per room. It's an absolute amount where there is an increase, and while of course it's an additional cost, it's not that material. It's not as material as, say, in Sri Lanka, where from not being subject to VAT, we went to a 15% VAT and then a 18% VAT. So it is a extra cost to the guest, which is a negative, but it's not such a material cost, the increases that have been announced so far. Candy missed, we expect that operations will start towards mid to end December. So next month is when we are planning to commence operations.
Thanks. There's a question on the tax status of the casino operations and whether there's any tax holiday that gets applied, and what type of tax treatment for the rest of the Cinnamon Life project. Of course, as we've said before, the project itself in terms of our hotel operations and the related facilities on banqueting, F&B, all that comes under SDP project, where we do have a tax holiday, but the gaming itself does not fall within that and falls under the normal purview of the gaming related taxes. Anything you
I think the important thing to note there is that the gaming will be conducted by a separate company, which is which will be a company of the Melco group. So that will be subject to the normal gaming taxes.
Staying with Cinnamon Life, there's a question on the steady state operating costs at City of Dreams or Cinnamon Life. So as I mentioned earlier, though we refer to it right now up to Q2, it's really been the ramp up costs because of pre-opening costs, really, because the hotel is not yet open. But now that it is open from Q3 onwards, what you'll see is it's not the pre-opening cost, it will be pretty much these sort of costs that will continue through because it is relating to staff. So there are certain launch related costs that might be there in terms of the initial marketing costs and things like that. But that's negligible in the context of the numbers we are talking of. So the primary costs, of course, will by and large continue because, as I said, it's really the staffing costs and, as you know, the operating costs of the hotel, the electricity, all these different things. But as we've said before, as we see momentum build up, now we're starting to generate revenue. So it won't be just the pre-opening costs, but we will start offsetting that with revenue that's generated through our F&B operations as well as room revenue. So it's a question of course, how soon we will ramp up, and we are hoping that that ramp up will happen quite soon. Like I said, it's very encouraging, and like Krishan just also touched on it, we are seeing very good interest in terms of conferences and inquiries and so on, but it does take a little bit of time for that to translate to actual sales or revenue. There's a question on the vehicle fleet at Walker's Tours and whether it's a significant portion of the balance sheet, and whether there's a potential for new energy vehicles to become a new a major revenue stream for the BYD business vertical. So in terms of I don't have the numbers, to be honest, on the vehicle fleet and the age, but it is not where we invest in the vehicles and carry it on our balance sheet. So we have a different outsource model that we run for this. So the age of the fleet, in a sense, matters less, and it's not on our balance sheet. In terms of the potential for the NEVs to become a major revenue stream, this of course will depend on the final accounting treatment, but it is a JV, it's a partnership, so the revenue itself may not necessarily be reflected in our P&L, but we will recognize the profits from that. And yes, it will depend on, of course, the volumes or the number of units that we see. But certainly based on the booking momentum that we've seen, and if that type of volumes do sustain, then this in the context of the retail business can be a fairly significant aspect of the business. I know we can't really answer this question, Krishan, but there is a question on when we will be able to import vehicles. So it depends on when the market opens out.
Yeah.
And I guess anyone's guess is as good as ours, though
we know that the previous regime did give some dates, but that has not been gazetted, so we don't know for certain.
There's a question on the CCS partnership with Reliance, Krishan, in terms of any update on the current status and momentum that we're seeing.
Again, it's only about 6 months since we started distributing in India. We've started with one flavor, Necto, which is the raspberry flavored drink, which is very well known in Sri Lanka. And we send the concentrate from here, and Reliance will bottles it and distributes using their existing Campa Cola facilities. Actually, it's been an encouraging start, but really too early to make a meaningful comment on whether we are seeing a big traction or not. But maybe in another 6 months, we can start commenting on that.
On SAGT, there's a question, what percentage of capacity we are operating at. So the total capacity of the terminal is close to, it's around 2 million TEU or thereabouts. We did about 511,000 TEU in the last quarter. So if you look at annualizing that, we are pretty much operating at capacity. Of course, there are certain things we can do in terms of throughput, yard space. So there are other factors that will determine how much throughput you can manage. So it can vary a little bit plus or minus, but we are pretty much operating at close to capacity. There's a question, Krishan, in terms of the East Container Terminal, that it's expected to become operational and whether this would be a threat to the WCT.
Yeah, the timing of when the East Container Terminal will become operational is not clear. The construction work continues on that the first phase of their expansion. The cranes have arrived for that space, but more construction work needs to be done. And while the West Terminal will commence operations, the phase 1, as we said, in the March quarter of next year, it's not clear when the East Terminal will begin operations. And even if they do begin operations, it will be only for part of their terminal. So in the context that today we have a 8 million capacity at the Colombo port, the West Terminal will add possibly the phase 1 another 1.5 million or so capacity. The addition of 1/3 of East Terminal won't be so material to the total capacity, current capacity of the Colombo port. So we have to see how quickly the rest of the East Terminal becomes operational. If it does become operational over the next 18 months, which from what we can see does not look likely, then it can have an impact. But if it is spread out over a few years, it won't be such a material addition of capacity to the port as a whole.
Staying with the ports business, there's also a question on the lease agreement, the concession at SAGT when it ends, so that ends in 2029. Krishan, in terms of the dividend payout, of course, keeping in mind that the current dividend per share is post the subdivision, but what I know we can't give forward guidance on it, but any visibility that we can.
I think the comment there is, we've been through multiple shocks like COVID and then the economic crisis, and we are, as you have seen in the last few quarters, our businesses are recovering. And we are coming to the conclusion of a very large capex cycle with the completion of the City of Dreams project and the West Terminal project. So as we start seeing the operations ramp up and revenues and income from those projects, together with the fact that the existing businesses are continuing to see a recovery, we will look to increase the dividends. And we have, as you know, in the past we've been paying higher dividends. So we will look to increase it, as our businesses start showing improved performance.
Going back to Cinnamon Life, there's a question on whether all the event spaces are available for events now and the timelines. So essentially all our event spaces are now open, ready for bookings. We've had a few events already. There are a couple of events ongoing as we speak. And all those spaces are now available for bookings. As I mentioned earlier, we have some of the restaurants that we've staggered the opening somewhat consciously just to keep that sort of opening momentum and excitement going in. But everything is pretty much now open or will be by December or so. Just a couple of questions on the bunkering market, where that bunkering used to enjoy higher margins historically is the comment, and whether we could explain what caused lower margins despite the encouraging volume growth. Now, bunkering, the margins itself, unlike a normal sort of retail type business, your profit is really more profit per dollar, profit per metric ton, which typically will be more an absolute amount. It can vary, of course, dependent on different factors, like even availability of inventory or what's happening in other markets, but it is really not a percentage of revenue that you can make. So as prices go up, you don't necessarily make the same margin. You may make the same absolute profit or maybe slightly more, but the margins in terms of percentage terms can decline. So just seeing volume growth itself doesn't necessarily give you that ability to price it up, unless of course there's a opportunity in the short term where the local market may not have adequate product availability or supply, which means you can price it. But keeping in mind that you're competing regionally with India and other markets, so there's only so much you could take your margins up, even if there's inadequate supply locally. Also, in terms of just the color on the bunkering momentum, I think we spoke of the outlook is positive. The number of vessels calling into Colombo, and of course with the West Container Terminal also starting operations, we'll see that much more shipping lines calling into Colombo, which will be positive for the bunkering business. The Red Sea crisis also has created that additional demand, which of course we can't sort of speculate as to whether how long that will continue or not, but certainly from the looks of what we see right now, we will see that momentum being there. There's a question on the anticipated timeline for initiating the development at the Finlays or Vauxhall Street site, and whether there are any insights that have been gained and how we would look at that particular project. So right now, I think for us, the priority will be in that sort of luxury, ultra luxury segment. We still have another 160 units at Cinnamon Life to be sold. Then it depends on what type of development we will look at Vauxhall Street. We've done a lot of the master planning and so on. The groundwork has been done or will continue to be done. But the call as to when we really want to trigger that project will depend on the sales momentum that we see in that luxury space, as well as the type of market demand we expect in that space. But in terms of the current pipeline, so we have the 160 units, like I said, to sell at Cinnamon Life. We have units at Trizend, which is more at the mid-market, and the suburban project as well. So we will have to take a call as to where we see those different segments evolving, but there is adequate inventory right now in our pipeline over the next year or so for us to realize and recognize revenue and profits from. and then thereafter we will take a call as to what we will do with that. So yeah, I think one thing to be mindful of course is that a real estate market requires macro stability, as well as now with the type of interest rates we are seeing, then we'll have to assess the long-term potential for some of these projects and which segment we really want to launch it in. Krishan, there's a question on, I think we've spoken of this before, but again, just to maybe reiterate our position on, what we plan to do with Cinnamon Grand and Lakeside, given the opening of Cinnamon Life and City of Dreams.
No specific plans. If we see demand for rooms in Colombo pick up, we will look at how we should position the two properties. They haven't been refurbished in some time. So, it really depends on the momentum we see in Colombo as a destination. And if things do pick up, we will look to reposition, refurbish and reposition those properties. But nothing specific that I can comment on at the moment.
There's a question on what has led to the losses at Trizen and whether we'll be able to cover up these losses. I think the Trizen revenue recognition, because of some of the costs that we had that were hit us due to the macro issues that happened a year or two ago, where we had to factor that into our recognition, is where we saw those losses last year. But now the recognition of the remainder of the inventory will see profits coming in, and yes, certainly the overall project will still show profits. There's a question on the ramping up of the charging stations at Keels. So yes, like we discussed before with BYD, the market has to open out and we have to still start importing the vehicles. But yes, we are rolling out the charging station network because we need to gradually build up that ecosystem. Of course, as we've said before, the range for the NEVs is around 400 kilometers and upwards. So for a country like Sri Lanka, you still have that ability to really travel even distances, but still we are certainly going to ramp up the charging station network and leverage off naturally our Keel's outlet network for that. On the financial services sector, there's a question on reversals of the ISB provisions post the restructuring and about the deferred taxation. So right now, I don't think I can comment too much on the reversal of any provisioning, but yes, depending on the finality of things and ultimately the percentage that the bank has provided, yes, there could be a reversal, but as to the timing of that and the nature of that, I can't really get into the specifics of at this stage. Krishan, there's a question on the KHL revenue hasn't picked up as significantly enough during the season to offset the rupee appreciation. Any particular reasons for that?
During the
last
6 months.
Yes.
Yeah. The revenue in Sri Lanka in the resort hotels was better. The room rates and occupancy were better than the first half of the last financial year. The impact really for KHL was from the Maldives, which, as I commented, there was a impact in that segment that we operate in, partly because of the lower arrivals from India. So that is the reason we are seeing the lower revenue. So.
Thank you. What's the expected number of Keels outlets to be added in FY 25 and 26? So this year we are looking at maybe around 6 to 8 outlets being added to the portfolio, and a similar sort of number, maybe up to 10 outlets depending on the site availability and as long as it fits in with our model. As we've said before, the long-term potential still is very much there. The density and penetration of outlets in the country still remains relatively low. We've of course stuck to our model in terms of finding the right land sizes, the land parcels, as well as the type of store formats, and of course with the current model that we have in terms of hot kitchens, prepared food and so on as well. So we will continue to grow the outlet network. Modern trade penetration in the country still remains at well below 20%. It's at around maybe 17% or so. So there's still a lot more potential for modern trade to grow. So we will continue that outlet expansion and ramp it up if those opportunities are there. There's a question on the privatization of the SOEs, Krishan, of the life insurance company, and whether UA would be interested in that.
No,
I can ask you to comment on that.
Yeah, I mean, at the moment, it doesn't look like the privatizations are going to proceed in the immediate future. So if it does come up, it's something that at the time we can evaluate. But I can't make a specific comment. Yeah.
Thank you. I think we've covered all the questions that we have for today. If there are any final questions, given that we have a few minutes, I can maybe just check to see. I think there's a question on the group's T assets and the current challenges facing the sector. Are there any plans to divest these areas? When we talk of T assets, of course, we are talking of our tea broking business, the produce broking business. And yes, we have our tea smallholder factories, which does own some factories.
Yeah, again, nothing specific, but it is no longer a core business for the group. So, we are looking to rationalize our portfolio. So it is possible, but there is nothing sort of definite or around the corner that I can comment. So.
There's a question on the largest NPL sectors at NTB and how much of the loan book is exposed to these sectors. I think in terms of the exact details, I'm unable to get into the details of, but I think the exposures that we had in terms of specific sectors, construction, all those were very nominal or maintained at a low level. So I don't think there's a specific concentration that the bank has. Public sector was also minimal. So the overall exposures over the last couple of years have been maintained. So what you're seeing, the stage 3 loans at 2.1% is quite low and has come off from what it was even last year. So whilst there are certain NPLs, I don't think there's a significant concentration in terms of the loan book. I think we've covered all the questions for today. So I think we can close with that. Thank you very much for your participation in the Q2 webinar. This webinar, the recording of this will be uploaded on our website in the next couple of hours for those who may not have caught the entirety of it. Thank you very much for joining. Have a good day.
Thank you.